Hello YouTube, thank you for tuning in. On today's video, I'll be reviewing the health of the US stock market and the US economy. If you like these types of videos and you enjoy this video, please like and subscribe. And let's get going. First, we'll start looking at the SPY, the S&P 500 ETF. And obviously you can see that there's a large increase here as far as price, and but the volume seems to be drying up. Typically, when volume dries up, prices go up. When volume returns, however, prices will probably come down. We're also looking at the MACD indicator here, which is showing quite elevated levels. And as you can see from previous similar levels, usually come crashing down. Whether that's going to have a lasting impact in the future is hard to say. But you can see here that there are red impressions on the histogram, and it looks like it could be tapering off, but based on this elevated activity, I'm not really sure how long it can go. Um, this one, went for a really long time. Looks like from September 2020 all the way till December 2021. So it's about 15 months. I guess it could stretch along. However, you can see here that the relative strength index seemed to have held up pretty good throughout this run. And over here, you can see a clear sort of downward trajectory for relative strength. Moving along, this is one thing a lot of commentators talk about, the U.S. personal savings. Now, I think this probably would have been its low. I guess that's in 2014. That would make sense, coming off of the great financial crisis. But it appears as if personal savings is sort of coming back. However, I do want to make a distinction. Personal savings sounds like what you might have in a savings account, or something like that. What it actually means, the definition of this particular economic indicator or stat, is how much money an individual makes minus his expenses. So, ultimately, it's how much you make after taxes, after you've paid all your bills, your net remaining remaining income. So that's not looking too bad. Let's move along to credit card balances. Now, this one, you can see this is spanning back all the way from 2003. It has never, ever been this high. Now, obviously, this is not adjusted for inflation, so that probably makes this in reality a little less dramatic. However, uh, this reading here is incredible. I mean, if we just take a infographic from the top here and you draw it up to the top there, you're talking about, oh well, that's not the right graphic. Let's see, info line. Talking about from the peak ever until now, you're talking about an increase of 26% on top. I guess you could say that between what was the date where it spiked out, in the last 2 years, that money's worth 25% less to account for inflation. I don't think that's the case. So it does indicate, or it seems to indicate, that people are relying on credit cards to get through day to day life. Now you could say, okay, well, they're carrying balances for a couple of months or whatever. So that brings us neatly along to delinquency on credit cards. So obviously here, great financial crisis, we had massive delinquency, of course. Then we sort of leveled out right here, which is 2015, and ebbed and flowed. But it does seem like it's sort of having a comeback, meaning people not paying their credit cards. This is a percentage here, so I guess the peak you're talking about close to 7%, and now we're hovering at about 3.25%. So people are, I mean, clearly based on this trend, just from, let's see, June of 21 until July of 24. These readings come in weekly, I guess. What's that? Yeah, the last reading was, I guess, 2 quarters ago. But people are giving up on their credit card payments. So that is obviously also a troubling issue. Now let's look at the delinquency rate for all loans. This seems to be having a comeback, but nothing super significant. The one thing which I was looking at was the interest rate. I'll pull that up here. Actually, no, just the mortgage. Here we go. So this is another major pressure point for a lot of people. The cost that basically the cost of shelter, and it looks like from 2022 until now. I mean, I don't think well, I guess it has been that high back before the GFC, pretty elevated levels. It looks like we're returning to that area now, and anecdotally, I'm hearing, just from people that I know and just in general, watching the news and so forth, it is very, very hard to rent. It's very, very expensive. People are paying upwards of 50% for their rent of their take-home income, and buying is also ridiculous. I mean, interest rates of what is it, 6.75%. That's going to have a major impact. I mean, it doesn't sound like a lot, but you're talking about 6.75% every single year, and most of the time the interest is front loaded, so you could be paying for 5 or 10 years, and the vast majority of your payments are to pay interest, not the principal. So you're not really building a lot of equity in the house. Um, so that's also a really troubling development. Now there is a lot of talk of more inventory coming on the market, and sellers receiving more pressure to to sell to lower prices and so forth. But even so, it could take years for that to really make any difference, especially with interest rates at 6.75% effectively, making it very, very hard for people to get into a house. Now there's a delinquency rate. Another stat I like to look at is residential construction. So this is insane. I mean, yes, it's part of a larger trend, but you can see here from 2020, residential construction has exploded. So I'm guessing this is a lot of the real estate companies, the builders building all these houses. That goes back to what we talked about before about building inventory, especially since people can't buy these houses are sitting on the market forever. So that might have some relief down the road. Back to the stock market. So in the context of all that we just reviewed, this doesn't. I mean, maybe people are. Yeah, I don't know. It's hard to explain where all the money is coming from for this. This is a huge. Like we could go and calculate the percentage here. We're talking about an increase of 44% in a year. October 23, okay, 2 years. Yeah, October 2023. Yeah, just a little over a year, maybe 14, 15 months. We're talking about from the bottom here to the top here, 44%. So where's all that money coming from? And these are questions that I'm constantly trying to figure out. You could make the case that a lot of it's being done through leverage. So if you have $1,000 in the account, they'll let you use up to $10,000. The other 900 wouldn't be called in unless the price of the asset or the ETF or whatever drop below a certain point, and then you get margin calls. So maybe all of this that we're seeing here, this 44% increase in a year, maybe that is all leverage. Maybe people don't actually have that money and banks are just laying it out. And it's literally a house of cards, which is maybe why whoever has most interest in this market is fighting so hard to keep it afloat. Now, if you look at you could see that it's been traveling since the bottom here. Let's see, this light green. Yeah, the light green is the 50-day moving average, and the blue one is the 200-day moving average. You're talking about above those averages. So not only is the stock market growing, but it's increasing in velocity. Meaning, if it slowed down and it normalized, it'd be somewhere between these two lines. But the fact that it's traveling above it means it's going hyperbolic. It keeps on pushing beyond its previous momentum speed, which is suspicious to say the least. I've been on the sidelines for like a year now, just kind of watching it and trying to understand it. and I still don't understand it. However, yesterday we saw NVDA basically gap down, and looks like just literally just touched its 50-day moving average. It's a mile from the 200-day moving average, which I get it. AI is the new thing and blah blah blah, but at the same time, these are basically crazy readings, and it's hard to make sense of it. And I think I've seen a lot of people who are just like, just buy, the price will go up. But if you don't understand what's happening underneath it all, you won't see the crash when it comes. And I'm not saying there's a crash coming. However, this kind of correction right here, this doesn't seem like a one-off event. This seems like it's finally sort of, the chickens are coming home to roost. I feel. You look at the VIX, not, I feel like everybody's reading the VIX. So because everybody's reading the VIX, it cancels out any usefulness. It's almost like a lagging indicator. You see the movement on the chart after it happens, or you might watch it as it happens. But to try and time it is really tough, especially since people, like, I believe this index is impacted by people who are, either buying options to short it, or buying options for long positions. But ultimately, this index is, subject to some manipulation. Yesterday, when Nvidia was sort of crashing, I think it went down like 16 or 17%, and the Qs went down 2 or 3%. You saw the 2, 10, and 30-year dip, 1-2%. And what that means is, if this number is negative, it means people are pouring into it. It has an inverse, they work inversely. So if you're buying bonds, you're actually driving the yield down because you're paying more for a fixed interest payment, or fixed interest asset. So yesterday, it appeared as if people were coming out of the Qs, or probably mostly NVIDIA, but I did see the other semiconductors also sort of getting clobbered and rotating into bonds. I'm not really sure what that means. I'm still a student of this stuff, but any comments that you have would be appreciated. I'd love to hear what other people think about it. Again, if you like these types of videos, please like this video and subscribe. And I promise to come out with better quality content. I'm still learning how to use all this stuff. So any commentary, any interaction whatsoever would be appreciated. Thanks again. Have a good day and happy trading.